the semiconductor SMH. That's the ETF that tracks him. Well, MKM derivative strategist Jim Struger says now may be a good time to load up on October calls to position yourself for potential narrowing of an underperforming sector. So do traders agree? Let's take it over to Larry Shover over at the CME Group in Chicago. He's the chief investment officer at SFG Alternatives. And Larry, I got to say, if you look at the chip stocks versus the entire tech sector, you can see why traders are concerned right now. They've been a real underperformer, haven't they?
Yeah, and I don't know if that's trivial trivia, but the last 3 times we've had a chance to bask in the glow of Bernanke, semiconductors have outperformed the market. But you're right. I mean, today we're playing a little bit of catch up, but they clearly underperformed, especially yesterday. The top 15 stocks I'm looking at, 8 out of 15 severely underperformed. Now we're seeing a little bit more outperformance today. I think this angry market that we're seeing right now is being led by semiconductors. With that said, Dominic, there's a lot of call buying into semiconductors, especially in SMH, the ETF that encapsulates that market. So what that's done, that's lowered skew, the price people are willing to pay for out-of-the-money puts versus out-of-the-money calls. Right now, we call that flat. Volatility's gone down as well. So right now, if you're like me and feel like fundamentals, conventions are out the window, and the central bank has a tailwind that we can't underestimate, you want to be in semiconductors. And a way to do that right now is to buy the SMH November 34-36 call spread, but buy it 1 by 2. It's a bullish call spread with an extra kicker. You're selling 2 of the 36 calls. Right now with the stock at 33.40, you can buy that for about 40 cents or about $40 per 100 shares. The break-even point for that stock would be $34.40. You have 2 months for that to happen. The best-case scenario is the stock goes to $36 a share. In that case, you will make $2 minus the 40 cents that you put into the trade. The worst-case scenario, we always have to talk about that. If the stock should trade above $36 a share, you will lose 1-to-1 above $36, given the fact that you're short an extra call.
Right. So you've got this. This is a ratio play. Why do you feel as though it's better to double up on that 36? Why are you shorting 2 particular contracts of that 36 versus just buying the one? You are not in any way perfectly hedged at that point, going past $36 per share.
Yeah, and right now I just want to take advantage of the tailwind we see in the semiconductors, especially in SMH. A lot of people are buying way out of the money calls, so that has just pumped up the price. In effect, it's lowered skew, and so I want to take advantage of that, express a bullish conviction, but also take advantage of options, because right now you're leveraging the fact there's a lot of bullish conviction. You can buy 1 of the calls, sell 2 of them for only 40 cents.
Now, overall, as you watch to see this trade play out there, we're also talking about maybe a couple months down the line here. Is there any situation you could envision where you would want to take this trade off before it heads towards 36 or beyond?
Well, I think if we severely underestimate what the Fed's going to do, and if they continue to pump more money, if some type of drastic thing comes in out of left field where we'll see like the semiconductors rally a lot further. But there's so many moving parts in the market right now. I have a hard time believing that we can see anything that's going to happen right now to get the semiconductors up above $36 right now.
Gotcha. Larry Shover, thank you so much for that insight there on the semiconductors. So